Yeah, welcome to the Root of All Evil podcast. But we got some big news
Big news.
yesterday.
What's been
Yeah, what
going on,
happened?
Luke?
Yeah, not personally, but definitely in the world of finance, we got some big news. I wanted to share this with you.
It becomes personal in a way. It's fine.
Actually, yeah. So we're covering the Washington Post,
Whoa, what's going on here?
amongst others, reporting. Yeah, the Fed yesterday, so
Huh.
September 18th, we're recording on the day after, the 19th. It says here that the federal rate cut interest rates for the first time since the beginning of the pandemic, lowering borrowing costs by half point. Does that make any sense to you?
Half point.
Cut interest rates? How many interest rates did they cut?
And how do you cut a rate? Some Fed scissors here. What's going on?
Right. And they lowered borrowing costs just today. So they just decided today that everyone's borrowing cost is going to be a half point less, I guess, right?
Half a point. Is that a lot?
Half point, right. Yeah, a percentage point, which is also known as 0.5%, which is also known as 50 basis points, which is known as 50 bips.
Nice. Get the jargon out of the way early here.
Yeah. So now they're talking about the benchmark rate. Now sits between 4.75 and 5%. But like, what does that mean?
Yeah. What benchmark?
Yeah.
What?
So that's what we're covering here today. We're trying to just dissect this and let everyone know what's going on and what this stuff actually means. It's a very big deal for finance people directly, but it should be, or it is a big deal for everyone else. They just maybe don't understand how it's connected. First off, when they say like the benchmark rate, what is that exactly?
By the term benchmark, I guess it's something that you use as a reference point to other things. So benchmark rate that the Fed controls, it's used as a kind of a baseline rate of which many other interest rates across finance, across the economy are all kind of described relative to.
So in this case, like when they talk about the Fed funds or when they talk about the benchmark rate, a lot of times, and what you'll kind of hear about when you read about this, they might refer to something called the federal funds rate, right? Mechanically, when the Fed talks about cutting interest rates, really they're only talking about cutting one rate. And that single rate is typically referred to as the Fed funds rate, right?
Pretty close, but not quite. But yeah, they do something along those lines.
Right. What do they do?
So I was saying not quite right. It's so they do control this interest rates. They don't control the exact point, but what they do is they control a range in which this rate can move in. So it's a market clearing rate. It's something that's decided by supply and demand in the market, and it's not rigorously held to a certain level, to an exact percentage level every day. It usually ends up being a similar percentage level every day, but it's allowed to fluctuate. So what they do is they're literally controlling a range in which this rate can trade. So they've got a specified area in which they want the rate to be in. It can move a little bit in that range, but not outside of it.
My understanding is what the Federal Reserve does, it controls the Fed funds rate. And like if you look up what the federal funds rate is on, say, like Wikipedia, so let me share my screen. This is sort of maybe you've probably heard this. You might even gone ahead if you're curious to figure out what the hell this actually is. Talk about the Fed funds rate, the federal funds rate, and it'll say the federal funds rate is the interest rate at which depository institutions, so places where you leave deposits, also known as a bank, where they lend reserve balances to other depository institutions overnight on an uncollateralized basis. So uncollateralized means it's just not collateralized with anything. You're not, say, like a mortgage is collateralized with the house. Uncollateralized means there's no asset that the bank could come and take if you don't pay back the loans. So it's riskier.
I'm going to go and leave my paycheck uncollateralized at my local depository institution.
Yes. Yeah, pretty much. So what this means though is in the past, at the end of every day, there was a certain amount of cash that a bank would have to hold, essentially excess reserves that they would hold at the central bank, at the Federal Reserve. And a bank will have literally a bank account at the central bank, and there it will hold cash. And at the end of the day, the Federal Reserve says you need to hold this much cash. And the thing is, with banks, there's money going in and out of the bank every day, right? There's money being deposited by its customers. There's money being withdrawn. The bank itself is borrowing from other banks. And at the end of the day, it needs to have a certain amount of that cash. Now, what the Fed funds rate basically is saying is, okay, if that bank wanted to go and it had to raise a little bit more of the reserves, it had to raise some more cash, it would go to another bank in the Fed funds market, and it would say, look, lend it to me overnight for this rate. And that rate is the federal funds rate. You'll see here the sentence here, the Fed funds rate, it's in a benchmark in financial markets. But in my understanding, when I think of like Fed funds, it's something slightly different. It basically, at the end of every day, banks have a certain amount of cash that they still have at the Federal Reserve. And the Federal Reserve will say, I'm going to give you an interest rate on that cash that you leave with us. As of like 3 days ago, the Federal Reserve will say to a bank, look, leave your cash with us and we will pay you 5.4% overnight.
Just below the top of that range. But
just below the top of the range, but they're aiming for that range. Yeah. And now they dropped it. They dropped it 50 basis points. So it's probably going to be like 4.9%.
So but how does that work? Like, so they're controlling it. Why does controlling this bank rate, the banks, trade cash with each other? What is, like, how is that done?
It's just, basic incentives. So if you're a bank and you've got cash, now there's always a question of where do you want to place that money in order to get sort of the most, economic kind of return.
Make the most interest.
Get the most interest, get the most money. And what the Fed is basically saying is, like, you leave it with us. You are not going to have any credit risk, right? Because we are the federal, we can print money if we wanted, if we absolutely had to. We're not going to go out of business. We are absolutely risk-free.
The Fed's the one that literally creates the money.
Yeah.
That money machine goes burr. They really amped that up recently.
And then it's just going to be overnight. So it's short term. You're not terming anything out. So it's super liquid. It's just cash. So the benchmark here is basically, this is, when you go out into the market, if you ever want to do anything else for a bank, nothing is going to be below that interest rate that's offered for cash at the Federal Reserve. Everything is now competing with this interest rate. This is the benchmark.
Sense if you want to, like, if you're a bank or even just a person lending money out, but in this case we're talking about banks. Why would I lend money to you, Luke, at 5% when the Fed's going to pay me 5.4%? You might not pay me back, but if the Fed doesn't pay me back, they can just make more money. No big deal.
So that's kind of the second thing to talk about here, as to, like, why is that interest rate so important? Mm-hmm. And we touched upon it kind of in the sense that by lowering that benchmark rate, the rate at which you're going to pay banks just for the cash to leave with the Fed, it's going to influence what are called like yield curves. So it basically influences all the other interest rates in the market. Now, this is going to influence, not only what banks sort of will want to see, like before they lend out their cash to give out a loan longer term, right? They might not need to see as much interest rate in order to want to go ahead and engage with the loan. But that also means on the liability side of a bank, they might not have to pay as much if they start cutting interest rates, right? Mm-hmm. So
the rate is both what you borrow at and what you lend at. So
it's what you borrow at and what you lend at. Yeah.
They're paying less to other people, to other banks in this case.
Right. So with banks, if you take it a step further, banks, obviously they're interested in how much their assets. So A bank asset is going to be like a loan that they give out to someone else. It's going to be their cash. It's going to be the securities that they have. And that whole essentially portfolio of assets is going to earn them a certain interest rate. Now that's only one half of the equation, though. The other half is
what are they like? What is that interest rate that they earn on it? How is that determined? So when you say loan, you're talking about if I were to go to the bank and I wanted to buy a car or start a business, I asked the bank there, listen, I want to buy this $100,000 car because I make great financial decisions. Can you give me 80,000, please?
Right. And the bank will say, they'll look at you. They'll sort of,
size you up a little bit.
They'll size you up. They'll give you, they'll ask you a bunch of questions about your income and kind of your other debt and all that stuff. Then they'll make assessment as to, your credit. Are you a good credit? They'll look at your credit score. They'll decide if you're a good credit or a bad credit. They might require that the car be collateralized, so they can they can take the car if you don't pay them back.
Repo man's coming.
Yeah, and then they're gonna decide to give you a loan. And part of the decision in making that loan, if you're a high risk, if you're a high risk, it might not mean they don't give you the loan. It might mean that they give it to you, but they just have a very high interest rate. But all of this, any sort of interest rate that
like if you have a lower credit score, it generally means that the person lending you money, they're not quite as confident that they might get paid back. If you've got low credit, generally speaking, over time, you borrowed money and didn't have such a great path to paying it back. If you have really good credit, the bank's going to be happy to lend to you at a lower rate. But again, we're all floored at that Fed funds rate because they wouldn't lend to me at 4% when they're going to get just over 5 at the.
I mean,
under 5 now.
Yeah, but yes and no, right? Because you do see rates out there that are below 5.4%. So like, there's this weird thing going on now where if you go out long enough, like if you go out, 3 years, 5 years, the amount that banks can say borrow or banks are willing to lend at, depending on what the counterparty is actually below 5.4%. So, I think we should talk about that. And I kind of want to talk, I want to debate you a little bit, or at least kind of get your views as to why that is. But basically, this is a description of an inverted yield curve in which the short-term rate, the Fed funds rate, or that interest rate on overnight cash at the Fed is actually higher than the long-term rate, which sort of goes against all financial theory, right? Financial theory would say, longer term loans should have a higher interest rate. And there's a bunch of reasons for that. One is just the credit risk. From one day to the next day, there's not going to be a whole lot of bad things that could potentially happen to you that would stop you from paying back the loan.
Mm-hmm.
But 10 years, who knows? 10 years, there's no guarantee that the situation's still going to be the same and you're going to have the cash to pay it back. So there's a credit risk there. And it's a credit premium. So it's one of the reasons why interest rates would be higher for a longer term loan. And another one is just
call that term premium. Longer term, more of a premium, term premium of the curve.
Yep. Just by the sheer amount of time you got to wait before you get the money back.
Like a little more interest.
Liquidity premium, same deal. But the idea is, for all these reasons, longer term interest rates really should be higher than short term. But that's not been the case. And anyway, that's how the Federal Reserve theoretically should be influencing the entire yield curve. And, that's going to be generally what they're talking about with the borrowing costs. Now, like, one of the things, though, that we sort of highlighted in that Washington Post article had to say that, it cut borrowing costs by, half a percentage point or 50 basis points. And that's like not totally accurate because for a couple of reasons. First off, the one rate that they did cut has really nothing to do with borrowing. It has to do with, again, this is kind of how I think about it. It has to do with how much interest you're going to earn when you leave cash at the Federal Reserve. What they mean, though,
believes in
is
the Federal Reserve because no
yeah,
one
well,
else
not
can leave
me.
money at the Fed.
Yeah, you, me, as individuals, no individual can have an account at the Federal Reserve. I can't go to the Federal Reserve and open a bank account. Only certain institutions, only certain depository institutions can do that.
Only banks and the government.
Yes, yes. The
Government.
Treasury does. The Treasury has an account at the Federal Reserve.
That's where they handle all their tax payments. That's the Fed. The Fed manages the government's money, the government's bank account.
That's right. Yeah, the Federal Reserve is the government's bank, the Treasury's bank. That's right. Yeah. But you and I can't go there. So what they mean when the news reports to say that like borrowing rate or borrowing costs have been cut, what they mean is sort of that next step, which is how it influences banks and how the banks are going to lend. But even that's not totally accurate. It's not like from so they cut it on the 18th and today's the 19th. It's not like the minute after they cut it, all of a sudden,
Right.
the borrowing costs cut. It's not there's suddenly like a dip and then it dropped down.
You can feel a wave through the economy.
That's not how it works, because banks were already lending and they were giving out, loans and stuff, and they were talking about these interest rates with the anticipation. Yeah, but I mean, just recently though, when you otherwise read in the news that markets expect, a certain number of cuts, what they're doing is they're just seeing where the 3-month, 6-month, 9-month, where those, yields currently are, and they're extrapolating from that what the market quote unquote expects.
Who are you talking?
Yeah, that's actually a good question. I don't know. Is that I don't know. I don't know who they are. That's a good question. Who are they?
Who are these people? Are they people? Are these AI algorithm chat GPTs, or what's going on here?
Actually, I don't know. I don't know who actually does it. Do you know?
Well, the banks do it, right?
The banks? Okay.
Well, I mean, just in general. So there's all of these different interest rates in the economy. And, we've been talking about this first one. But everyone borrows. You and I borrow, banks borrow, countries borrow, companies borrow, everybody borrows. Everyone has all these different interest rates, and they all mean slightly different things. But the one thing they all have in common, the Fed funds rate is underneath them all. That's the baseline. That's the benchmark rate where things should be. That should be the bottom. But because the world's a complicated place, banks give out long-term loans. Interest rates were super low a long time ago. Now they're super high. So everything in the world is not at that exact level. Things don't instantly change as soon as the Fed cuts rates, as we were saying. But instead, what people are doing is, and then I think the other thing you mentioned before, when you were talking about a bank giving out loans, it has these securities, I think you call them, right? Financial securities. So then instead of just trading cash at an interest rate, they can also trade securities. They can trade loans, and they can trade bonds. Like a treasury bond is a loan to the government. So people are constantly trading these different things, and the price at which they trade, just like anything else, you go to a store and buy something, it has a price. A loan has a price on it, and you can agree to sell it at a good price or buy it at a bad price. And the world's a big, complicated place, and there's many banks with hundreds and thousands of people that are all sitting around talking to each other on the phone, trying to buy and sell these bonds, trading their cash back and forth. And so at the end of the day, now you've got all these different interest rates. They're all flying around, but they all come back to the Fed funds rate. That's the soft benchmark that kind of helps guide the direction of where rates should be going in the economy, or at least where the Fed wants them to go.
Yeah. So that includes, just bringing it back to like an individual person, by cutting rates, you can potentially make anything that like you and I or just a normal customer would want to borrow. So, the most obvious ones are like a house, or anything else that you would pay for with credits, like a car.
Student loan.
Those are going to make it a student loan. Those are going to make it more attractive. And those are going to spur people to go out and spend.
But But couldn't banks just keep giving you the same high rate, because we don't borrow at the Fed funds rate, just the banks do. What's to stop the banks from just being greedy like they always are, right?
I mean, I guess it's competition. Because cash and loans are extremely commoditized. It's just like it's not like Chase's money is somehow better or different from Bank of America's or something. You can just go down the street to a better rate. Um,
Now, it's all the same money, you're right, but the person that's giving it to you is different, right? That's bringing it to that credit part. Banks have credits just like you and I have credits, or some credit score. If I leave money at a bank, it's not the Fed. That bank could have, they could screw up. The bank could fail. They could not manage their liabilities the right way. They could fall below that minimum they need, and It's a Wonderful Life, famous bank run scene. That's what happens. That's what's happened through history and happened back then. And the government has since done some things to help stop that, but it still happens on a larger institutional level nowadays. But maybe that's another story for another day.
so then, all right, let me ask you something. How does the Federal Reserve decide to cut rates? Like, why do they cut it now? And why 50 basis points? Why not 25?
That's a good question. So the Fed's, yeah. So I mean, the Fed's raising and lowering rates all the time through the years, and why do they do the things that they do? I guess for many reasons, but kind of like the Fed funds as a benchmark. Everything the Fed does is guided by like a principle that they're given by Congress. So it's called their dual mandate. The Fed is created by Congress. It's given their power by Congress. They're politically independent, but that's another story for another day. But Congress says, it's more or less Federal Reserve, you control the money supply. You do this in an apolitical way such that you're not benefiting this politician or that, but you're doing it such that it's the best for the economy. So what does the best mean? They define the best as this dual mandate. And so dual mandate is that it's number one, they want to, they call it promote full employment. They want to make sure everybody's got a job that wants one. And then the second is they want to promote stable prices. They don't want inflation. They don't want prices to be rising all across the economy whenever the goods themselves aren't changing at all, and then people can't buy as much, and everyone's worse off. You can trace back to those two things. They want to keep inflation, at a reasonable level, by like a low and predictable level. Before this recent bout, earlier this decade, the previous decades, it was about 2%. And so that's actually the Fed's level. They target 2% inflation. Employment, that's a little bit different. It's tougher to kind of target absolute level of employment that you want. The population's always changing. It's growing. People are, coming into the country. People are leaving the country, all these different things. So that one's a little fuzzier. But regardless, at the end of the day, they're trying to do those two things. They're trying to promote those two things. So whenever you have interest rates, all else equal, if you've got high interest rates, it's going to be more expensive to borrow money. An interest rate is more or less the price of money. Money is its own thing, but you can also buy money. Buying money is by borrowing it and paying an interest rate. So whenever interest rates are super high, also like in our last episode, we were seeing if you put down that down payment at that house, you're depending on what the interest rate on your mortgage the bank gives you, your payment could be, I don't know, what was the number, like $2,100 or $1,100.
Yeah. So for those listening, though, the episode that you're referring to is a unlisted thing. No one can actually watch it.
We'll relist it someday.
Yeah.
At any rate,
right.
Yeah. So interest rates are the cost of money, and all else equal, when they're higher, you have to pay more. If you have to pay more, you have less money to buy other things. If you have less money to buy other things, your my my buying is your income. If I buy something from you, I'm getting something and you're receiving money. If I can't buy anymore, you're not getting money now. And then if you're not getting money, you're not buying other things. And then all of a sudden, and this happens at a business scale too. So whenever a business can't sell as many things, they have to start cutting things. And unfortunately, what that means a lot of times, whenever you know, the economy goes south, or like however people refer to that, people start getting laid off. It's not that they did anything wrong. The company just doesn't have enough money, and it's not like. So anyway, I'm getting a little off track there, but so everything the Fed does is in chasing those two things. They want to make sure you keep your job and prices are stable. And so then the question is, well, how do they do that? And the answer is, traditionally, they do it via, well, they still do it this way. Traditionally, the only way that they could do it was by moving this federal funds rate directly. So, and they still move it directly today. And they've got some other things that they've cooked up over time that they can also do to influence these rates. But for now, we'll talk about the Fed funds rate. So why did they lower rates today? So as I was saying, if rates are higher, everything, again, generally speaking, are going to be more expensive. You can't spend as much, might be at higher risk of people losing their jobs, unemployment, like we were just saying. Now, on the other side, if you lower interest rates, it's exactly the opposite. It's cheaper now to buy money, to borrow money with which you can then buy other things. So that's going to, all else equal, people want to buy more stuff. They're going to buy more stuff. Supply and demand. If you've got too much demand, your prices are going to rise. And that's the other extreme that you don't want. If you've got prices too high, interest rates too high, people might be at risk of losing their jobs through that. Just how people have less money to spend, and that feeds on all the way through to, what your boss is telling you at work. And then if interest rates are too low, you can buy too many things. And if you buy too many things, there's not enough things for the amount of money there. So prices have to rise to match that. And that's what inflation is. So it's this delicate balancing act the Fed is always playing between having interest rates too high, you can't spend enough, you might lose your job, or having interest rates too low, now everyone's buying too much and inflation's getting out of control. In both scenarios, everybody's worse off. If you lose your job, chances are, or there's an increased chance I'm going to lose mine. If I lose mine, then my neighbor might lose theirs as well, and then on it goes. And then all of a sudden, you could have millions of people out of work, and that's what we see in recessions through time. And then again, so exactly the opposite whenever rates are too low. You start buying too much, everyone's fighting for the same set amount of goods with more and more money. Prices got to rise to account for that. Because if I'm selling something for $10 today, but now all of a sudden someone else wants it so bad, they're going to give me 15, I'm going to charge 15. But if interest rates are too low, someone else could come and say, well, I'll give you $20 for it. And then all of a sudden, you've got inflation everywhere. So that's how the Fed decides. They have this, they're balancing those two things. So then the next question from there is, well, how big? Like how do they gauge these things? And go back to our unlisted episode. We'll have to make sure we get that up again. But they measure these things through what people call economic indicators or whatever. Basically, the inflation rate. They measure the government measures the inflation rate, and the Fed watches it. In the same way, the government measures employment, and the Fed watches it. So they see these two things going back and forth. So as we all know, over the past 2 going on 3 years now, we started getting inflation. So what did the Fed do before so before inflation was super obvious, before it was obvious that it was coming, no one knew it was coming before it was here. Interest rates were actually at zero. And so maybe that's yet another story for another day. But the Fed chooses sometimes to have no interest rate altogether, to bring it down to zero. So, and there's many reasons they do that and a lot of history behind it. But only a couple of years ago, at the beginning of 2022, I believe, interest rates were still zero. So people were buying too much and we started to get all of this inflation. So naturally, that was pretty apparent. I mean, it was tough though, because everyone lost their jobs due to COVID. But once everything started coming back, people were getting their jobs again. Anyone who wanted a job could get one. So people started spending. So then we had inflation. Interest rates were so low, people could borrow money, not quite for free, but pretty close. So the Fed sees inflation, and again, all back to this dual mandate. So they want to make sure that they don't want inflation too high. Inflation got up to almost 9%, and that's far too high. They wanted it at 2%. So they raised interest rates. So throughout 2022, they started from zero, and then every meeting that they have, every 6 weeks or so, they decided to raise those rates. So they took that interest rate that they pay banks, like we were talking about, and instead of paying you nothing, we're now going to pay you 25 basis points, that quarter, 1%. So they start raising it, and then they were paying 1%, then 2%, then 3%, and they got all the way up to almost 5.5%. And so that kind of brings us to where we are today. So over time, we've seen inflation start to come back down now.
This is what I think you had mentioned before. So we're looking at, you look at this all the time, right? The Bank of Labor statistics. These are like the inflation rates. And basically, this is the inflation rate. This is by, every year, I guess every August.
Past 20 years or so.
Yep. And, you'll notice that it sort of spiked. This was in, 2022. And then kind of lately it's popped around down to this 3% number and it's sort of been there for a while.
What are those gray bars there? Like back earlier in time?
Yeah, those are recessions, right? Typically, whenever you see something like this, they are going to be a recessionary period. So, this is the 2008 financial crisis. And I guess this is the one that happened in COVID, right after COVID hit in 2020. But then there was I guess the story is there was that whole stimulus package. That's kind of what was lately been to blame for the inflation, which kind of happened here. The Fed raised rates, and sort of now we're down here. So now they feel like it's ready to start cutting. It's been here for a while, right?
We're almost down to that 2% level.
5%. And, then they're also following, as you said, the dual mandate. So they also need to track along with what unemployment is doing. And if they want to feel comfortable there, they don't want to, they want to keep unemployment low. And I guess they feel comfortable that now is the time to start sort of easing off on the brakes.
That's right.
I mean, that's my understanding.
Yeah. I mean, that's pretty much it. They want to ease out, like inflation was going up too much. They start applying those brakes a little bit, spend a little less. Now
these are the brakes right here. So this is the Fed funds effective rate. And so, these gray bars, these are the recessions. This is 2008. So they kind of jacked up interest rates here. Once they saw a recession was coming, they, hit the accelerator. So they cut interest rates. Then it was at the super low rate for a long time. It was essentially zero. Then they started creeping back up, and then COVID hit, and bam, they went right back down to pushing on the gas. And once inflation crept up around here, they started punching the brakes. And so now they're starting to feel like, okay, we've hit the brake enough. Time to start pushing the gas a bit. So they're starting to cut it.
That's right. So how do they determine how much to hit that gas again? What's
I don't
at 50 basis points. Like what do they usually do?
Yeah. That was kind of more my question to you. I understand typically when you sort of, getting these ease off cycles, either it's just like, okay, we're hitting a rating a recession. That seems to be the biggest indicator for when, we want to the lower interest rates or recessions happening, or
Yeah,
has happened, or has clearly happened.
or is about to,
Um,
or you think one's about to happen.
you think one's about to happen. And it looks like here they kind of started creeping down a little earlier in the early 90s. This is before my time. So how
Before
do they
the
decide to do?
You're
How
a
do they
young gun,
decide? Yeah, how do they decide to do well before my time in finance? Uh, how did So why did they decide to do 50 basis points? Why not 25? Do you know? I guess
Yeah. So if you, so if we're really deep into it here, and we're looking at this chart, we can see, is like as you're pointing out, this it's going up right there, then it goes down real quick. Certainly in that area, and if you move forward in time, right there, same thing. And like if you squint at it, there's like this old adage, and people talk about with the Fed. It's whenever they're moving around interest rates, the Fed. Uh, um, they usually take the stairs going up, and then they take the elevator going down. So you can see these things like kind
here
of
it is. Yeah, this is a good example. Stairs going up,
yeah. If
elevator
you
down.
zoom in, it's like every meeting they did a
Stairs
quarter,
going up, elevator down.
little steps going up, and
This looks like they took the elevator up here.
that's at least I think one of the key reasons why they might have chosen to do 50. And so it's weird. So, but I was just saying they take the elevator down. Let's say that it's they cut a lot quickly, but in one sense, 50 is not a whole lot, but in another, they usually move in 25 increments.
One
So
cut is, I guess we should say, yeah, one cut means 0.25. Like in the
right.
industry, when we talk about how many cuts, we're talking about how many increments of 0.25.
And that's a pretty
So
much
this was two cuts. That's usually
right. Two cuts all in
50
one.
basis points.
Yeah. And that's just an arbitrary number that they pick. There's other central banks that move in different increments, but for the Fed, they like 25. That's the size of their staircase. But recently, it's like if you look at 2017 and up to 19, that's a decent staircase there. But yeah, like you were saying,
that's years. I mean, they're putting. I mean, think about it. Like they are in a increasing interest rate regime for literally years. From it looks like it kicked off like November 2015, and then it kind of ended March 2019. Which I like,
takes a long
4
time.
years. Yeah, 4 years of just slowly increasing rates, and then bam, they're down in like less than a year. They're back to zero.
Right. But this time around, it's just kind of glancing.
This time around, they were jacking things up by like three steps.
They were doing
so 75%, right? That was a lot. I mean, that's when you started seeing those news reports come out, be like, "Oh, the fastest hike since the 1980s" or something.
That's right.
Because they just hadn't had to do it before.
So there's that one special I word that keeps coming back. Why was it the biggest since the 80s? What was special about the 80s? 70s into the early 80s, that was the last. We can see it there. So this isn't inflation, but this is interest rate.
This is the Fed funds rate. I got inflation here back to 65. So this is 1980 every year.
Wow, yeah. So suffice it to say,
and this only goes back past 20 years. Can you go back farther? Guess not. Stick with this guy. Yes, this is back down to the 1960s. But yeah, you can see 1980, super high. 13%. So we never got that high,
Not even halfway there, even.
I don't know. I think we hit it like, what, 9%?
Oh, no, sorry. I was talking about like today. 2 days ago, we were at 5%. 5% was the top, and now we're already.
Oh, no, this is inflation. This one here, this is inflation.
Oh,
sorry.
Yeah. Okay.
I'm switching. Yeah, I'm sorry. I'm switching graphs on you. This is the effective rate. Yeah, and that's true. Back there, I guess it peaked in 1981 at 19%, which is
90%.
nuts. That is crazy in today's terms.
Can't imagine what that mortgage
19%,
payment would be.
that would be crazy. But it did it. It finally broke the back of. But that's like a whole history lesson. That's like an interesting.
Yeah, that's another
Paul
history.
Volcker. Yeah,
But for now, it's
he had to break. That's like an interesting story. He just had to break the back of inflation, and he did it with a very long recession. But they did it.
right. So
Anyway,
the Fed tries to move carefully. They try to move slowly. That's what they did last decade. But since so the biggest rate hike since the 80s, because inflation was the highest since the 80s.
yeah.
It's really as simple as that.
Yep, they did not want to go back to a persistent high inflation scenario, so they really went all out. So yeah, maybe that's the reason why kind of the two cuts were warranted.
Yeah, and I mean, there's one way of thinking about it. Just because it went up so quickly, maybe we could bring it down a little more quickly. But that's really no one knows why. It's the Fed or these they're made up of a committee that gets into a room and they meet for 2 days and then they vote. They vote. They say what do you want to do with the interest rate? They go around the table and they ask everyone, and the vote won for 50 for decreasing it by 50. So at that table, they're all having the same conversation that we're having now. It's like, do we do 25? Do we not do anything at all? Do we do 75? No one really knows what's coming because we were raising by 75 a couple, 2 years ago. Everyone was a little bit shocked by that. So maybe it's all right if, we shock them again right now. But who knows? Maybe they're thinking that. Maybe something totally different.
So I had one other question I wanted to ask you. That is, like, do you think this system, this sort of kind of benchmark system where the Fed is just kind of controlling this really short-term rate, just like the overnight rate that they give banks for the cash they leave with the Fed? I mean, theoretically, they're supposed to be able to increase interest rates across the entire curve, but like clearly they weren't able to do that. So let me walk you through this chart.
Yeah.
This is the Treasury. So this is basically the price at which the U.S. federal government can borrow money. And this is compared to the federal funds rate, which is the rate that we've been talking about. So this rate in black, you can just see how it sort of acts as a floor in a sense. Like certainly you can see that there's some influence here.
It's definitely that floor.
Yeah. I mean, you can see some of these other ones sort of sneak below it.
Yeah, you can leak out underneath, but
it
looks pretty good.
It's pretty good. I mean, obviously there's some relationship here. Something's going on. And in times here, you can see that if you just try to follow the colors here, but you can see that like the 1, 2, 3, 4, 5, 6, 7 months, those are all like almost at zero. But when you start getting farther out to like 30 years, 20 years, you can see that there's a progression up. So like the longer term stuff has a higher interest rate, which is sort of what we would expect. That's sort of how it's theoretically supposed to work. So, but then you start getting into these times where it's like, okay, these lines start getting super bunched together, which sort of implies that the interest rate that for like a 30-year loan and for a 7-year, 2-year one is like pretty close to each other.
It almost kind of looks like that, like top blue line there is almost acting like a ceiling compared to the thick black line on the bottom.
Kind of, until we got to, and this is what I want to talk to you about kind of more recently, where like suddenly this blue line now is below everything. So like, whereas before this, the Fed funds rate, the effective Fed funds rate was supposed to act as like, the bottom. This basically says, all right, here's your yield curve. It's supposed to go up from here. Recently, just over the last year, it's been inverted, which is to say the Fed funds rate has been higher than the 30-year. So like, how come the Fed has not been able to, how come this theoretically has not been working like it has in the past? Like, why do what's your take on that?
Yeah, I mean, I would say it's not that it's necessarily not working like it has in the past, because if you go back here and kind of squint at these previous periods when you're at the top, I think it's most obvious back like 2006, 2007, where that same thing happens again. Now all of a sudden that floor is you've got everything falling through the floor. Like what's going on there?
Yeah, it's
That
inverted. I mean, this when these all
yeah,
get
that's
bunched
what
together in the 30 years, sort of below these shorter term rates, you got an inverted yield curve,
yeah.
and that's yeah. People talk about that being a signal to a recession, um, and it's kind of accurate. Sort of get bunched up, a big drop, and they sort of spread out a little bit, and they start bunching up. They're like, oh shoot, something's coming,
Right.
and
Better
then
get
yeah,
this thing
then it
going.
drops again. And kind of lately, they've been bunched up together for a while because people kept thinking there was a recession coming. They're like a lot of sharp cuts were going to happen really soon. And if that's the case, then something like, you know, if you wanted to put out a 2-year rate and you expect like the next day rates are going to be back at zero, then all
Mm-hmm.
of a sudden having a 2-year rate at even below what the current short term rate is makes sense because you're working under the expectation that these, you know, Fed funds rate is going to drop to zero and all the other
Right.
short term rates going to drop back down to something super low.
The expectation. That's really the key point there. Because at the end of the day, these, again, we're looking at interest rates. Every interest rate is directly related to a price. So these are just prices at the end of the day. When you, whenever you're buying something, particularly these, financial securities, it's not like a good you go home and use in a certain way. It's something that you put in a portfolio and you hope you're going to make money off of. But you have so in order to choose, what you want to buy and what you want to sell, you have to have expectations. So yeah, if we're sitting here today and I think the Fed is going to lower interest rates and you come ask me for a loan, I'll say, yeah, sure. Let me give it to you today because I think the rate might be lower tomorrow, so I want you to pay me more. If my and that's the thing, you might have the opposite expectation. You might think, oh, there's no way it's going to lower. In fact, I think they're going to raise those rates again for inflation. I think it's still too high. I think they're going to raise rates. And so that's how you get these longer term ones that don't quite follow that black line, that kind of floor, just as well. And the further you go out in terms of how long a loan is, the more subjective it is about what you think that right price should be. So that lower black line, it's pretty cut and dry. It's one day, Fed controls it directly. And on the opposite extreme, though, what's it worth to lend the government money for 30 years? Is it worth twice the Fed funds rate? 1.5 times the Fed funds rate? It's really, uh, um, it's not clear. And so these things are traded every day, and just it's a free floating financial market.
But yeah, so that's pretty big news today. So now we are in a declining rate environment. Um, look out for mortgages to kind of continue to drop. We'll see what the Fed decides to do in 6 more weeks. Maybe look at 25, maybe another 50. We don't know, but we expect it to just be slow, gradual cuts
Right.
until some number they're going to stop. Then the next question is, when are they going to stop? We don't know. The Fed doesn't know. They can only guess.
Right. We're all playing this game together with the Fed.
Yeah. All right, man. That's it for the Root of All Evil podcast.
That's it.
I'm
Good
Luke.
talking to you, Luke. I'm Joe.
Yep. And have a good night. All right. Bye.